Negative gearing is not a strategy. It is a tax outcome.
Every single relationship, property management business is based upon a multiple of its annual income stream from its rent roll.
The core thing to focus on is the running of a very effective and profitable property management business.
Knowing your customer ultimately and knowing them deeply and knowing their goals, knowing what they want with the property is so important. The fundamentals for property managers and for property management businesses have not changed.
They've given this opportunity to be able to reorientate themselves with how they see themselves and how they approach property investment and property investors. Well, what a great time to be a property manager then.
You're listening to the Property Management Excellence Podcast for insights that drive rapid rental growth.
Welcome back. Great to have you with us. PMX Podcast. Alex Whitlock with you, co-founder of Managed, director of REB. We're not going to dig into the budget. I think it's been done from every angle. I'm sure everyone tuning in is familiar with the changes, how it may impact them on, maybe down to a granular level. What I want to talk about really is how and where this is going to reshape property management now. I'm sure some people tuning in think it won't make a jot of difference. I think there's other people tuning in who are going to be questioning what this means. We're all very familiar with the impact on negative gearing, grandfathering, et al. But what impact does this have on the value proposition for property managers with their customers? And it's something that needs to be considered. You've got, in many ways, a couple of different cohorts. You've got your existing customers, and of them, some of them will be negatively geared, some of them won't. Some of them are going to be grandfathered. Then you've got new customers coming in that will not get the benefits of negative gearing. The issue is there an opportunity for property management to rethink what its proposition is? I think firmly that it is. I've got guests with me today. I've got a long-term friend, business partner, also co-founder of Managed, Phil Tarrant. And I have Alexander Laureti, who has worked with us on a corporate level for many, many years. He is also the head of finance and compliance for Managed. Alexander is very, very well versed with the taxation system over many decades. Guys, look, I want to get into this, Phil. I'll kick off with you because you, like myself, property investor for many, many years. You're probably a little bit more politically geared than I am. Certainly you sort of have a focal point on what happens at a government level. I don't want to get into anything emotional about the budget. Some are going to like it, some are not. I want to really think about, we were chatting offline. We've both got significant portfolio. We've got a shared portfolio. We've got our own individual properties. How many of your PMs have got in touch with you to talk about what impact the changes may have?
Oh, simple answer, zero.
Alexander?
From my perspective, thank you for having me, guys. I've tried to share some information about the budget. I think that overwhelmingly there was a lot for PMs to digest. And I think that the changes that came out from a negative gearing perspective, from a capital gains perspective, seem to be catastrophic for property investors. But if you take two steps back, I think the fundamentals for property managers and for property management businesses have not changed. So at the end of the day, I think that my counsel to all of my clients has been, let's just wait for the legislation now. Let's act where we need to. Sharing information about the budget has been something that we started off doing, and I think everybody's kind of overhearing about it now. I think that, it's tiring, but from a property management perspective, I think that if you don't take a proactive approach to dealing with your existing owners, you're leaving an opportunity on the table to get closer to them, to show that you know what's going on. To show that you're being proactive about things as well. So it's a shame that nobody's reached out to you, but I'm sure that your accountants have and everybody else has, and I know you were down there in Canberra as well. Property managers are now custodians of an even more important asset.
Yeah.
And, they have a real obligation and responsibility, but also an opportunity to improve their businesses and improve outcomes for their owners if they can get this right.
Yeah, well observed, Alexander. I made reference to this idea that the last time I was on there, that first time, the only time I was on the PMX podcast, that accountants pretty much play a critical role, sort of connecting and helping shape decision making within the SME sector of Australia, hugely reliant on. And I sort of made the analogue that property managers should be doing the same for property investors, rather than just being a provider of ensuring the compliance regime of the business is appropriate. A good accountant is engaged and connected, helping to shape strategy and decision making. That's the same of what a property manager should be doing for the property investor. And to your point, now more than ever before, they've given this opportunity to be able to reorientate themselves with how they see themselves and how they approach property investment and property investors in an environment which is unsure, it's uncertain. People need help, people need their hand held. But once the immediacy of these changes or the shock of these changes sort of wash through, and we all know the different stages of decision making, how people react to stuff, people are going to start thinking a lot more responsively and proactively, and therein lies the opportunity for property managers to get involved. I haven't heard anything, nothing from property manager, and I haven't really seen too many property managers be front line. Also, on social media and other areas as well. It's like they've retreated a little bit, and maybe they're trying to work it all out. But property investment, well, properties have become different in that they've now got a layer of them being an asset, and the asset being wealth creation, the asset being cash flow, all that sort of stuff. But now this concept of an asset, that the fact that you've got properties that can be positively geared, that can be negatively geared, and properties that can't be negative geared moving forward. There's a whole new world to all of this.
You say something though, Phil, and you say property managers retreated, but I don't think that's correct. They've never emerged. They sit there in the background. So few of them take the opportunity to take a leadership position. And I've said this since we started this podcast, is that PMs always have been the real enabler for owners and investors, but they often end up being the custodians of maintenance and leasing and compliance. Sure, that's the doing bit of the job, but there's a big bit that has been missed. But I think moving forward, you're going to get winners and losers.
Well, what a great time to be a property manager.
You're going to get winners and losers. And we'll maybe talk a little bit, Alexander. We're talking offline about, I don't want to get into sort of the taxation system, but there's some positives for those looking to grow a rent roll. But if you don't get your proposition right, if you don't grasp the opportunity with owners, because if you look at what the government is trying to do, they're trying to reduce the number of investors and increase the number of homeowners, right? At a base level.
Yes and no. When you look at the actual numbers coming out of the budget and all the commentary around it, they're talking about helping 75,000 Australians into their first home over a decade, right? That's 7,500 people. 7,500 people a year.
It's not a lot.
You put that in perspective of a population that we have right now, it seems to be quite misaligned. One of the core objectives of the budget is to there's a view from the government that the money that you generate through labour should be taxed the same way the money you generate through investments, and they're saying there's a distortion to that right now. So their focus is trying to tax investments or investment income the same as you tax labour income, and that's the very nature of it. So all of the rationale around changes to the tax regime is intrinsically connected to that. Now we need to remember this still needs to go through the Senate and get approved. Whether or not bits will be carved off or pulled apart, and they might say, no, okay, we're not going to do that. There's going to be horse trading in the background going on. The assumption is that the Greens will vote alongside Labor, and therefore these things will go through the Senate pretty easily. But I expect there to be some horse trading. There's got to be some horse trading around there. We were looking at, and this is a story for property management. There's two tails for property management moving forward. There's how do you actually go about, to your point, creating a business that creates value to landlords and ensures that you're relevant and will thrive in that environment. Running in parallel with that is that how you choose to structure your business. Yeah. And that's where accountants are going to come into play. Structures become a lot more important. And it's very difficult if you're setting up a property management business or any business and you view it from where you are today, but you don't often think about what it looks like in 20 or 30 years' time. Yeah, a lot of people want to build a big business, but a lot of people can't really comprehend what that looks like. So the decisions you make at the point of setup or establishment is going to have more ramifications moving forward. So, but you've got to separate the two out. You know, all the stuff is irrelevant around how much tax you pay. Should you have a sale event or you sell your rent roll? If you build a bad business, it's just irrelevant. It doesn't matter. So the core focus of this, Alexander, is that property management is still about building the best business you possibly can do. yes, there'll be some tax changes and consequences to that moving forward, but you've got this moment in time where you completely transform the way in which you can build out a property management business, exactly what you're saying, by being forward-leading and changing, because right now property investors need more help than ever before.
We're going to go to a break in a second. We'll get back into this. But Alexander, when we were offline, we were sort of having a chat in your office, which I had to call short because I want to talk about it on the podcast. But you said that one of your young rising stars in your firm, who clearly understands every single aspect of tax and also the ramifications of the budget, who'd been saving up to buy a property, asked you what?
Yeah, so this goes to the whole opportunity for PMs and giving their advice. But one of my rising stars in the office, nominated for award within the Momentum Group, came to me and said he'd been saving for an investment property for a number of years, and he's very bright, understands the tax code, knows everything, and just said, "Is it still worth me buying an investment property now, given all the changes in the budget?" And I was crushed because he had a strategy in place and he knows exactly how the system works, and he knows or could know the benefit of negative gearing, and knowing that the changes to negative gearing, for example, is just a timing difference and you've got to treat it a different way. But accumulating wealth through property as a strategy and becoming financially independent, and one day providing for your family, one day providing for your kids, using an investment property as a way to buy a property and then move into the family home and having a roof over your heads. It's a beautiful aspiration, and it's the version of the Australian dream that's been working for 25 or 30 years under the system. The fact that aspiration was taken away from him, or that he questioned,
or he's questioning,
was so sad for me. And I said, it still is the way to go. It just changes the dynamics of how long it's going to take you to turn that negative gearing into positive gearing. And because he hasn't bought an investment property before, he hasn't realised that negative gearing is only a temporary thing. Nobody actually goes to buy properties to negative gear forever. You need to lose $1 to get back tax.
You make a really important point.
Let's take a break, Phil. Let's get into it. We're going to need to take a break.
Okay.
Alexander, Phil, stay with us. We're back in a couple of seconds. Welcome back. We've got our wheels in motion here. I had to cut Phil short before the break. I'd like to focus this proportion of the podcast looking at investors, current investors, investors coming in. Phil, I cut you off very rudely to get a break in.
Well, I've forgotten what I was going to say, but it would have been, I think it was connected to this idea that
it's about negative gear. We're looking at negative gearing.
About negative gearing. So already I'm seeing, and be very, very careful out there, because you've got these some would say seismic challenges, some would say small challenges to potential changes to the tax regime, and already I'm fatigued about talking about it because everyone's sort of saying the same stuff. But I'm seeing a lot of people come out of the traps on social media, and everyone's either got a workaround or a hack or something or other, brewing in the background. And I'm hearing it already, and people talking about a negative gearing strategy. And I'm like, negative gearing is not a strategy.
No, it isn't.
It is a tax outcome.
Yeah.
And to your point is what I was going to say before the break, Alexander. It's a tax outcome at a moment in time. And that tax outcome will change over the course of an investment depending on the decisions that you make. Already a lot of people are talking about now keeping things structurally negatively geared forever because there's an asset that you can negative gear it and offset it and do elsewhere. But to those younger Australians out there, don't get absorbed or obsessed with it. You still need to find a good property that's in a good location. It's going to grow in value. Yes, there may be changes to the tax regime around it, but you will be negative geared for a period of time. And let's be clear, nothing has changed. You can still get negative gearing and you still get the 50%.
Yeah.
You can still get the 50%
just the
CGT.
tax.
You just got to buy a new property.
Yeah. Yes, very true.
So don't get too absorbed or obsessed by it all would be my counsel.
But my point, Phil, is without going deep into the rabbit hole of taxation, it is about opportunity. It's about rethinking from a PM perspective, exactly what you are and what you represent to your customers. Because I've always felt frustrated that PMs don't have the courage to be advisors to their owners. Like, it's not hard to do.
I think a lot of people would probably say that's a bit unfair, Alex, and a lot of PMs will tell you they're already doing that. They'll go, yes, we're asset managers. Yes, we're integral part of an investor's journey, and we do this.
That's the doing, but it's a communication thing, Phil. And I know that PMs do exactly
just to
that.
defend property managers there.
Sorry?
Just to defend property managers there.
But this is what they do. I'm not talking about what they do. Of course, they're asset managers. It's about communication.
Yeah.
So doing something, if your owners don't understand what you're doing and how you're doing it and why you're doing it, of course they're asset managers. But if I don't get the value proposition as an owner, then I don't. You got to remember that a lot of owners, Phil, have one investment property, and they're not property investors. They're, cops or teachers or tradies. They have a job and a life. They're not a property investor. It's a ridiculous notion. They're a human being who works and tries to get ahead, and they have an investment property. And
can I go deeper on that?
Yeah, no, sure, do.
On that asset perspective. So your property managers, I see them as owning they're custodians of two different assets for their investor base or for their owners. They are the custodian of the capital asset, which is the investment property.
Absolutely.
And it's their job to maintain and look after the future health of that property.
Yep.
And the opportunity for them is to be forward-looking and saying, you will have a maintenance schedule coming up, you may need capital repairs coming up, but from a capital perspective, they need to help preserve that asset. And they need to think about their owners as owning houses rather than saying owner number 57 on my rent roll.
Yep.
Right? And if they can think about the capital value of that asset, they'll start to think proactively. And that's the opportunity to think proactively about future maintenance, about optimizing the value of the asset, about helping them go on a journey where they can then say, well, if your asset is well maintained and looked after, you'll be able to buy one. They are also the custodians of the revenue stream that comes from that investment property. And the revenue stream and the capital asset often fight each other because the cost of a capital repair will impact what you make from the property in that particular year. So you've got the long-term outlook and you've got the short-term outlook as well. But particularly from this budget, or even just the opportunity for property managers as well, if they're seen to be optimising that revenue stream for their owners, they're adding value for their owners. So if they're proactively going and saying the market rents for your property are increasing, let's not kid ourselves. Rents are going to go up as a result of these budget changes. Yep. All rents are based upon market forces. And if 50% of the market is putting their rents up, a market review is going to say rents have got to go up. So that is just an unfortunate impact.
But back to Alex's point around communication, I don't know how many property managers are going to be well equipped enough to actually have those conversations with tenants about rising rates, rising rentals.
Tenants
to tenants.
Tenants, yeah.
Yeah. It's going to be some very difficult conversations for property managers.
But maybe this needs to start with the owners to then go back and give education to their PMs, to then go back and say, we want to run a business where we want to be forward thinking and proactive. The opportunity for them is to be we've talked about it separately, where you talk about having an A team of advisors around a property investor, for example, or even a business owner, where you've traditionally had the accountant as a trusted advisor. You've got your mortgage broker, who's very important in feeding in liquidity and helping you leverage your assets. Why aren't property managers in that conversation?
Well,
they are custodians of such an important asset.
Some of them are, but not enough. And so I've got the privilege of watching certain agencies grow extremely quickly. Some of it, organically, some of it through acquisition, and the best of them through both. But I see an understanding of the value that they represent, and this is a really fundamental thing. And again, when I say that, you say property managers are asset managers. Look, of course they are, but it's about a communication thing. It's about having the courage to articulate what you do, and just to educate. There's probably a bigger gap in understanding and knowledge than there's ever been before. There's a lot of confusion. There's owners, would-be owners. Not everyone's negatively geared, right? I don't know do you have any idea how many investors are negatively geared? I'm going to throw you.
I saw a piece yesterday in the papers that said 60. It's either 61 or 67, nearly 70% of all investors in northwestern Sydney or western Sydney are negatively geared. And these are the cops and the nurses.
That's a valuable statistic because it should tell PMs.
Maybe 71.
I don't know how many PMs know how many of their properties are mortgaged or not mortgaged. I don't know if they actually know what the situation is for their owners.
They're saying that these changes, should they go through the Senate and become law, will affect about 8 billion bucks a year in positive tax receipts for the governments is what this is going to be. So that's coming out of the pockets of negatively geared investors and all those who are realising the value of their assets through CGT changes. And when I was in Canberra over the last week, the core data and stats they're positioning from the opposition is around, doctors and I think even the leader of the opposition said that in his response speech. He spoke about the nurses and the fireys and the coppers who are all negatively gearing. It's a real attack.
And they always have been.
And they always have done, right? And remember, 90+% of all property investors in Australia own between one or two properties, right? So, this is this cohort.
And they might be trying to hang on to the family home with interest rates rising, with cost of living pressures, and they've got one investment property and they're relying on the negative gearing strategy to be able to say, I want to do something else for my family and build wealth a second way outside of the family home, because I always say you can't buy groceries with your house.
Yeah.
You need an income stream to be able to build upon. And to be able to hang on to that investment property now, the grandfather properties, they can. So they've got an artificial advantage compared to all the young people who are going to want to be starting their journey right now, which is such a shame.
They're saying now.
So what I want to
The
do,
opposite
bringing
intended
it back
effect.
to the context of the PMX podcast, we've got a very, and we'll talk in the last section about the real opportunities for growing rent roll, to move forward. So in the business of owning, managing, being part of the team that works with owners, tenants on the rent roll, you've got a business that you've got to be a custodian of. So you need to be operating in a way that is supportive of the business that you're in. Now there is, looking at owners, negatively geared owners, people make bad decisions at times of confusion, right? So it's not your moral duty as a PM to make sure that owners don't make bad decisions, but it is a business consideration to make sure you don't get owners selling or disappearing off your rent roll because they're making bad decisions in a bit of a sort of a knowledge vacuum, right? So I think that it frustrates me that PMs, principals, don't capitalise on the knowledge and the value proposition that they have enough to connect with their owners. Now, I'm not saying that individual PMs should be reaching out, with unsolicited messaging to owners, but I think that principals should be thinking about how they can connect, how they can educate, how they can safeguard. I'm not saying take up the role of an accountant.
They need to free up their time, Alex. And I think that that's one of the reasons why our agencies who use Managed actually value the fact that they have more free time, because they've automated certain processes that slow them down. Not needing to do that month-end trust accounting, automated payments. It's giving some time back. Now, business owners reinvest that time often in just running the business. So some business owners have reinvested that time in growth. So if you acquire new rent rolls, if you add more doors to your property management agency, you are growing, but you don't necessarily have any extra free time to be able to provide those communications or anything else. So part of it is tools. Part of it might be the opportunity to use AI to kind of generate some branded materials for you and send it out to your owners. But business owners and property managers in particular need to find time savings in their automation to be able to do the value add stuff
the time to
and
go
to
and
hand
do
that
this.
back,
Yeah.
right?
I think you're right. You've got to have time. You've got to look at, and we won't get into it in this podcast, but again, reducing manual tasks, reducing the stuff that you're doing day to day, to have the time to spend with your owners and with your tenants as well, right? To have meaningful conversations. We'll round off this section. We'll get into sort of the great future for property management and for growing rent rolls. But I think that having that time to then have those conversations with your owners, understanding and knowing your owners. I don't think any. I've mentioned before on this podcast when there's a couple of a couple of PMs that have had meaningful conversations. One of them was Shaw's. When I first signed up with Shaw's, they came along, wanted to know everything about my investment property. That was very, very, very. It was very reassuring. H&B and new management and a couple of others have wanted to actually understand what my goals are. But most, and I've been, Phil, how many PMs have we been over the years? We must have 50 different PMs over the years.
It's so just trying to map who they are is a job in itself to remember who's someone's left. At least they use an email address which might be PM4 at whatever. Right?
Yeah.
So at least you've got some contribution.
But you have the opportunity, and by the way, you have the opportunity at sort of first connection with your owner to have that conversation. But guess what? You can initiate. It gets harder if they've been on your rent roll for some time, but have the conversation now. check in with your owners, understand if they're impacted. You don't have to become an accountant. You don't have to become an expert on tax.
Can I give a suggestion how
Sure.
that might happen? Because not all owners are made equal. So if you can spend a little bit of time segmenting your client base and saying, even with Alex, with your properties, you may have some properties that you own in your personal name.
Yeah.
You may have some properties that you own in a family trust. You may have some properties that you own in your self-managed super fund. If your PMs know the difference between the owners and already know that some are going to be more affected than others, in the budget, there was no mention of self-managed super funds, untouched, left alone. The people who own property in self-managed super, no changes required. You don't need to send them budget updates or anything like that or hassle them. They're not going to make any different decisions now that they did before. But if you can then go back and identify Alex Whitlock, and Alex Whitlock has a certain amount of properties that are going to be affected by these changes, and I just know what questions that might be asked, and I can help Alex with an FAQ, or I can help him with information that relates to his properties affected because he owns them in trusts or personal,
I've got some views
compared
on that,
to the others.
But we probably want to go to a break. Yeah.
Let's take a break there, guys. Back in a couple of minutes. Welcome back. Look, thanks for joining us. Phil Tarrant, Alexander Laureti. We're getting into it here. It's one of the podcasts that I think you could be on here for several hours. But I love the chat and I love the angles that you bring, Alexander, and you as well, Phil. You know, it's. I think that I've believed for a long time that property management is owning a rent roll is one of the most exciting opportunities in business. Let's get away from the sort of the day-to-day, very challenging doing of property management. But what a fantastic way to build an asset.
Well, this is the point, you know, and I said at the start of the podcast, there's two things running in parallel. It's running of the business, and then it's the structure and potential tax consequences connected with it. The core thing to focus on is the running of a very effective and profitable property management business, and the other stuff will just work out. You can't control it.
Yeah.
What can you control and what can't you control?
Some of it may change.
You can control how you run a business, the tax regime connected with running your business.
Yeah.
You've got, yes, you can have a vote, but you know, if Australia votes collectively. What I would caution on though is and I don't really like the term, but it's really staying within your lane. I think a lot of property managers need to be very careful that they're not moving into a world of providing financial advice.
Yeah.
And this is a really core point. You know, in order to get the right orientation in terms of structure of your organisation, tax structure, obviously, you know, you can speak to an accountant who's well qualified and got all the different qualifications that they need. That's great. But in terms of how you're connecting with your property investment clients, be very, very careful.
But I see this very similar, Phil, to, you know, we work a lot with mortgage brokers, and
Yeah.
it's quite a similar proposition because mortgage brokers can't provide financial advice, but they can provide a lot of advice on how debt is structured, right? So understanding what you can provide advice on and what you can't is critical. Property managers can certainly give advice on the local market, maintenance of the property, getting the right tenants, understanding what the owner objectives are. Those are all things that they can provide advice on without any qualification whatsoever, and a host of other things. So I think you're absolutely right. You know, advising that owners should be buying certain properties, yeah, I'd be very careful on that.
Well, advising them what structure to buy properties
Not
in.
structure,
Yeah, no,
but,
from
and sorry,
Yeah.
to clarify in case there was any misinterpretation there, I don't think at any point in time a property manager should say you're in the wrong structure, or if you're considering what to buy in the next structure.
But buying and selling, they've got to be very careful about
Well,
as
buying and selling, I suppose, one easy win is to say, well, geez, if you know that your owner is going to sell, please make sure you refer it to your sales division and keep that sale in-house.
Yeah, absolutely.
But, you know, from the perspective of are you thinking of selling or not, knowing that potential property could be grandfather saying, did you want to check with your accountant or did you want to check with your advisors before you sell this property because it might be advantageous to sell is one thing. Just knowing that some of your property owners, I think knowing your customer ultimately and knowing them deeply and knowing their goals, knowing what they want with the property is so important because you might have some owners who've got a 5-year investment horizon and you're optimizing for the best outcomes within the next 5 years. You might have young investors who've just, you know, they're 30 years old and they want to hold it till they're 60. You've got to optimize that property for the long run. So how they're structured is just a knowledge point. What their goals are is just a knowledge point. But it's about having more conversations with your owners and saying, how can I best help you?
Most owners are going to sell for good reasons. Let's be clear. They're going to have a reason they're going to sell, and what the PM says or does is probably going to make little difference. If I'm deciding I'm going to sell my property, I'm selling my property. I think this comes back to the beginning of the conversation, though. If I understand my customer, the owner, if I know what their goals are, doing that fact find. Look, we work with, we know broking. We've taken out hundreds of loans over the years with brokers. They do a fact find, going through the process. Phil, what are you buying? What's your goals? What are your long-term objectives?
They need to do that through law, though.
Sorry?
They need to do that through law.
They do, but nonetheless, it's still part and parcel of understanding the customer very deeply. Yeah. The PMs are exceptionally focused on compliance. I mean, they're the highest, I believe, I've said this many times, accountant, property manager, broker are the most important people we're talking about property investment here and being an owner, most important people on the journey. The PM is the only perpetual person with you on that journey as an owner. Yep. My accountant will, deals with tax, and that's a snapshot in time. They're not there permanently with me. My PM is with me every step of the way, every single minute of every single day, hypothetically, because they are connected with the property that I own, right? So on the way in, taking the time to understand, do the fact find that other professionals would do. Yeah. I know that PMs, a lot of them care, but it's a communication thing. I'm not criticising property management in terms of what they do. It's about missing an opportunity on the way in, because if you get that connection on the way in, you then become aligned. I don't see any reason why, we own and run a mortgage broking business, right? We connect with people on our loan book regularly to find out we know where they've bought, we know what loan they've got, but we check in regularly to find out what's changed, right? Why would you not do that as a PM?
Property managers have the opportunity, just by the nature of the way they work, to have more touch points with their owners, with their tenants, because you send out a monthly statement, you talk to them throughout the month for any maintenance issues that come up. So ultimately, compared to your mortgage broker, who you might speak to at a transaction point, who might do an annual review, compared to your accountant, who you might speak to, depending upon your relationship, once a month, once a quarter, once a year, ultimately, if it's just a tax accountant who doesn't do any advisory work, who doesn't get stuck in with you in your business. But the property managers have so many more touch points, and touch points or conversation points are opportunities to add value along the way. So just thinking about where can I add value in those conversations for anything along the way, you're in such constant contact. If you can find a way to integrate extra value, however you choose to do it for your agency, you can really do great things, and you can build that relationship of trust.
You could be the custodian of trust. And through that, look, I'm not suggesting that every PM becomes connected with a mortgage broker, becomes a conduit for an accountant, but you can be, I'll tell you, property management, investing in residential property has been turned upside down. Now, look, as you say, Phil, nothing's really changed, but it's something that's in flux at the moment. Moving forward to build long-term, sustainable revenue streams, profitable businesses, and we were supposed to be talking in this section about the opportunity for property management. I think before we get into the sort of how taxation is going to affect that, there is this opportunity to be the custodian of trust in investing in property, residential or commercial, right? There's a lot of people tuning in and have commercial portfolios as well. Be that custodian of trust. It requires, yes, as you said, freeing up the manual tasks that you do, but to have the time to deal with your owners, but the courage and understanding what conversations to have. It opens up opportunities above and beyond just your management fee. I believe in that relationship. But look, let's talk now.
Can I tell you why that trust is valuable, to bring it back to the property management business itself? Every single relationship, property management business is based upon a multiple of its annual income stream for its rent roll. So every single relationship that you bring in is worth roughly between 3.5 to 4 times multiple of the annual income stream that it builds in. So if you protect that relationship, if you grow that relationship, you're ultimately protecting your business value. You're ultimately finding ways to grow it. If you can do great things for your owners and they refer you to others, if you can build a referral engine in your business, you can then go ahead and say, well, one owner can become 2. If you then go ahead and have this amazing attraction business where you're known to be a great property manager in the area, and you decide to grow your business by rent roll acquisition, once you've got the system, once you've got the playbook that's in there that says I add value to my owners over and above my management fee, every single time that you manage to keep that relationship in place, it's worth 3.5 or 4 times multiple in terms of the value of the business. That's important for building a long-term structural business. That's important for the value that it provides if you want to leverage up and buy another one. But just to quantify how important each and every single relationship is in dollar terms, every relationship is very valuable from a trust perspective, but from a monetary perspective as well. And you've got to keep that in mind as a business owner.
And maybe the opportunity for property managers is to look at this structurally or organisationally. And if people that don't work inside of property management, they think property management is just one person that does everything, right? But there's many different facets to this, whether it's a leasing manager or a BDM or the actual property manager or the maintenance.
Yeah.
So. And there are different skill sets required to do those roles. So it's just not this veneer that everyone is the same. There's structural orientated differences.
So getting something. So there are what I would see as being the next gen agencies. You've got to be a certain size and scale where you start to departmentalize your proposition. So you kind of got to go. This comes back to though, where are you going with you? Are you muddling along and adding the odd property here and there? I'm seeing on platform, on managed, our agencies are. They're acquiring these sort of like bit part kind of PMs that are kind of agencies that have stumbled into it. They built a sort of a handful. Some of them, sort of 100, 200, 300. We've got one agency who's looking at 800 acquisition on their rent roll. So I'm seeing next gen agencies, which are on our platform, they are acquiring. They're growing very quickly organically, but they're also acquiring because I think you've got principals that have grown a rent roll. They now have inefficiencies in that rent roll, and they're now questioning where the value lies. They've got, a lot of the rentals are below, sort of market value. So then they're not getting the return on their fee. Owners aren't getting the return. So Yeah,
so this is the opportunity. Who actually does the inverted commas asset management aspect of rent roll management inside of a business? Who is the person providing that value to property investors go over and beyond the structural compliance aspects of a portfolio? And I think property managers will approach that very differently. But the key thing is not to be too absorbed and obsessed with the tax regime connected with the asset you're creating versus the functional aspect of doing good property management.
Tax is always secondary in any conversation. Tax is a cost of doing business. And it's a break on doing business, but it's also an opportunity if it's done wisely. But every property manager who runs an agency, the principals, they run a business, and then they run the business of property management. And knowing how the business is operating and being able to have a helicopter view and saying, how is my business operating? How is this translating into a financial outcome? Is my business growing? Do I know my growth metrics? Do I know whether I have churn in my rent roll or whether it's growing?
Well, they're very different skill sets, right? They're very different skill sets. And a good property manager doesn't necessarily mean they'll be a good owner of a property management business.
Not necessarily.
Often the opposite. And a lot of principals, and I think about Managed, for example, some of them were born out of property management practices, and they were property management. Many were born out of very different enterprises, right?
One of the guys who's had one of the fastest growing rent rolls was an accountant and a property investor.
So it didn't hold him back being an accountant.
Well, I think accountants are probably going to be the biggest winners in relation to supporting SMEs around this, like articulating, like being able to work. This is the advice of a good accountant, and I would urge all property management or property management principals to ensure that they have strong relationships with accountants, not for the purpose of their own business, but also as a referral mechanism. But a good accountant can actually help people bounce between, or property management owners bounce between the running of the business and then the ongoing sort of compliance regime and tax consequences connected with it. That's an art.
Knowledge is power. And at the end of the day, if you can help business owners understand their numbers, understand the metrics of their business, they can make better decisions. Yes, accountants are going to be busy as a result of the budget. We haven't seen the legislation, but there's no need to panic, first of all. So we need to counsel caution. We need to see the details. And luckily for most property management businesses, the lion's share of them are going to be structured as companies already. And being in a company structure, you're already done most of the hard work. So if you spend the time setting up your agency from day one in the right structure...
This is what I want to ask you, Alexander. Would there be any difference? So for aspiring principals looking to start their own business now, is there any difference to the way that you would see setting up your business compared to a month ago?
Well, certainly companies have been prioritised as the trading vehicle of choice. I think they always have been. I think that trusts have been seen to be the asset holding vehicle, but not necessarily the trading vehicle. There are businesses that do operate through trusts. There are pros and cons to operating through trusts, but the challenge for business owners has always been that you're not allowed to retain your earnings and keep on growing the business. Trusts need to distribute to a beneficiary, whereas companies can retain their earnings, they can reinvest, they can grow. If they make profit,
And you can retain losses as well and get.
You can retain losses to offset against your future income, and you can build up franking credits to provide fully franked dividends to your shareholders as well. So, companies have always been the structure of choice. Some of the announcements in the budgets are talking about companies being under attack, but that's more from the perspective of bucket companies and trust distributions. I think it's beyond the scope of this podcast to go into there, but the structural trading businesses, which traditionally, if you were starting from day dot or wherever you've been, would probably be a company, and that has not changed under this. So if you're in a company structure at the moment, then just focus on running a better business and making the most that you can, because if you sell it at the end, the government's going to try and take some. If you make your money along the way, you've got all number of payroll taxes, other taxes along the way that try and make it harder to be in business. It's very difficult. There are some incentives that were thrown out there in the government to help grow businesses along the way. Not many, but a handful. Ultimately, you guys got to go out there and do it for yourselves if you're running a business, but a company structure is the way to go from that perspective. And if you're not there, there will be restructuring opportunities available as announced in the budget. The legislation will tell us that. So yeah, keep in good contact with your accountant from that perspective, but just run a good business.
Just right. Nothing's firm yet, and it will take some time to push these through into legislation. So if you were thinking about setting up a business today, you'd probably wait to know exactly what
I think
the
you would.
legislation would look like.
I think if you were setting up a company today, for a property management business today from day one, I think that your most likely outcome would be to select a company structure from doing that in the early stages. Obviously, and tax advice has to be tailored to the individual. So there are reasons why you may not want to choose a company structure. You may already have existing entities that you want to reuse or repurpose for that reason. But certainly companies are in a good seat.
You don't even know yet whether or not they'll carve out aspects of this as it goes through this sort of consultation debate, because there is a lot of pushback from business community, startup community in relation to business investment, right? So you just don't know what may happen.
Yeah, and business owners ultimately you're in it to make an income stream along the way, and property management owners are exactly the same. You want to make your money as you go, but what do you do with that? You need to extract your wealth, and you either need to pay down your mortgage or build a second income stream. That second income stream has been made harder now to grow your wealth. People have traditionally tried to park money in shares and invest in ETFs. The CGT discount has been changed, and fundamentally that'll change the way people invest as well. So growing your wealth is just going to take a little bit longer in this new paradigm, but that doesn't mean that it's impossible. Businesses as well, just to talk on company structures as well, there was no change to the small business concessions if you own a business in a company structure. So the small business CGT outcomes for small businesses less than 6 million in assets or 2 million in turnover. There are ways to reduce your capital gains at the end, but they're captured at the corporate level, and then when you distribute out that income, the government's going to try and take it at the end.
And this lot of feedback you're getting from the younger cohort who, the government's gone out and said we've orientated the budget to support all these young Australians to get them into a home, right? But the backlash is that, well, you've stopped all those things that were made available for everyone else to get ahead. And then if I want to actually go into business by myself, you've disincentivized all those things as well. So why do everything? Hence the reason why some pundits are calling it an attack on aspiration. But it's interesting to see how the younger folk are actually responding to this, because they're not stupid, and they'll see through this sort of veneer of headline, concepts like generational inequity and all this sort of stuff. They're seeing it, and that's got to get debated hard. So I look forward to see how that plays out over this next period.
Very tempting to get deep into this.
Don't need to.
Well, I think, but to bring it back to your property management,
But why start a property if you're a young, hungry, ambitious property manager or BDM or whatever your job is in property management? Why would you leave that now to go and take on the risk to do this yourself?
So I'll just park that for a second. I want to be more specific. For most new agencies are driven by sales agents. Yes, there are. It's probably 1 or 2 out of 10 will be sort of PM based, very focused on the rent roll. But really, for Alexander, there's some sales. There are some sales businesses only. There's a lot that have PM as an afterthought. Do you think moving forward, this is talking as an accountant, the value is in having a sales-focused business, a bit of a rent roll focused business, or being very focused on the rent roll?
So most integrated agencies that have a sales division, a property management division, unfortunately the property management division is seen to be the ugly duckling.
Yep.
There's no glory there. It's the mundane work. It's the drudgery. The sales guys are out there making the big sales, earning the big comms, going out and partying on weekends and having a great time. The smart agencies are knowing that the sales profits that you make and those high commissions that you make, you need to roll that into a recurring income stream.
Yeah.
And the property management business is safe as houses. Sorry to say safe as houses given the budget, but the recurring income stream of looking after the asset. Traditionally, that's where I see business owners move from sales, buy a rent roll, and then at least that way they've got a place to see the efforts translate into something sustainable. Because if you stop selling, your commissions stop coming in.
Or if the market changes.
If you lose your number one agent to a competitor, your sales are gone. But if you have a property management business with a recurring income stream, something catastrophic has to happen in order for you to lose all of your tenants all in one hit. It is a great business to be in, of property management, if you treat it, if you nurture it. And the smart agencies who have a sales division, have a property management decisions, work two ways. They work together simultaneously.
I'm sure you'll be providing advice moving forward on, and this is not to give a tax advice because I'm not an accountant, but I think what will happen, there'll be a new layer of sophistication in how people set up real estate businesses moving forward. And rather than just having one business that has sales and PM all wrapped up within it, I would imagine that you're probably going to have these two things
absolutely
running in parallel with each
again,
other.
not time to kind of go in, but I look at the landscape. Phil, you're a lot more in tune with the landscape than I, but I look at just the evolution of the landscape with the rise of buyers agents. Now with you've got people who want to find a way to own property and to get ahead through doing that as owners, as investors. You've got the rise of buyers agents. There's a lot of very bad advice coming from that quarter, and
some good, but
a lot of bad.
Yes,
some good. Like we know the buyers agents that really care and work hard and deliver good results. But even then, and this is why the PM to me is so important, because even with a good buyers agent, right, I might still end up with not a great property. Who is the person that partners the owner? It's the property manager. Right, it's so critical, and I think it's this massive missed opportunity. They're so important moving forward to the ownership and investment journey. Right, even really good. You've got a lot of bad buyers agents or mediocre buyers agents, which means mediocre purchases. One of the things, I'm not talking to the investor cohort here, but you've got this notion that getting if I go and buy property, it's going to be a good investment. Well, guess what? It isn't necessarily. Not every single property investment is a good investment. Some are better than others. The PM for the 70% of properties that are managed, they are the custodian of that relationship and of the property, and they can make such an impact on the outcomes for the owner by being switched on, clear, transparent, and they're receiving something that somebody else has bought, but they are the partner. So helping that owner understand how to get the most of what they've bought is so valuable if you get that right.
And Alex, when you said some properties can be good or bad, you didn't say negative gearing once. You just said that each property on its merits, a good property
Absolutely.
in a good area is going to grow, whether it's negatively geared or not. A bad property in a bad area is going to have problems no matter what. Negative gearing is just a secondary outcome in terms of buying good properties.
But you get these issues of maintenance, right? It's not the PM's fault. If I've bought, whether Phil's advised me as a buyer's agent, whether I've gone and bought a bad property myself, if it's got maintenance issues, it's got maintenance issues, right? So, and again, for me as the owner, if I'm not educated by the PM, I can end up just going, oh, this is broken, that's broken, the wall's got, water running down it. I don't necessarily blame the PM, but a lot of people kind of don't link their buying decisions with the news that the PM brings. So again, I'm sort of being very repetitive here. The opportunity is to educate the owner, certainly at the way in, at the point where that property goes onto your rent roll. Educate them, look at the property, tell them what the realities are going to be about maintenance. And again, with the backdrop of negative gearing, getting cash flow from your investment ultimately has to be the journey, unless you're looking purely at capital gains, and that's changed now.
Well, you read through the budget papers and you hear what they're saying. They're saying that there might be a 2 to 3% decrease in property prices as a result of these changes. You put that in perspective, and I don't know over what period that is. I can't remember exactly the numbers, but it's not a lot. It's not like they've completely undermined property as an asset class in Australia. They've just tinkered in the edges around how much of a drink the government gets when property is transacted.
We're talking about opportunity. So the budget is the budget. It's neither good nor bad. You can have your opinion on that.
Yeah.
We're talking about a huge opportunity.
So I think
property management.
To be fair to property managers, and I've got a property manager who looks after a property of mine, and I know that whenever she calls me, it's to deliver bad news because something major has to happen. And I've got a commercial investment property in this one, so anything that comes up is expensive. But she always frames it. She's fantastic. She always frames it in why doing this repair will add value to the property and why it's important in maintaining the relationship. So I think property managers are fighting a challenging battle because they're the deliverers of bad news, kind of like accountants are delivering tax news, which everyone hates to hear. But if they are coming at it from the perspective of, but if you do this, it will add value for this reason, they can really reframe that relationship and be seen to be, my property manager is giving me an opportunity to improve the value of my property from that perspective. So they are often the deliverer of bad news, but bad news can become good news.
It's only bad news without the necessary information
framing
around it.
Yeah.
So
I think we're just before we finish. I think we're forgetting a very important aspect of this, that the property investor in that regards, right? So. And I was just thinking about something you said then. Even if your property manager is proactive, a lot of property investors
they don't want to hear it.
They need training.
Right? But to that point there, I had a thing the other day, and from a property manager they went, I think you should. There's something about linking the light switch to the fan or something in the bathroom, right? It was some spurious electrical thing, right? And I sort of wrote back, it was, I don't know, $500, I can't remember how much it was. And I went, why do I need to do this? And they went, it's preventative maintenance. You've just painted some ceilings in something or other, and this will mean your paint will last longer. And I wrote back, is it safe as it is right now? And they said, yes. And I went, don't worry about it. I don't want to spend the money. Just leave it, and I'll worry about painting it later on, right? But if you so even if the property managers are proactive in that regards, I think investors probably need to recalibrate their attitude to property managers a little bit more, rather than thinking every time they call is bad news. Every time they call is positive news because they're trying to help shape a positive investment. Anyway.
But that goes back to knowing your customer as well, because the property manager who's dealing with Phil Tarrant on that particular one might have framed it a different way if they knew the standard PT reaction to
spending money.
To that, but not just to spending money.
You're an educated owner and you understand property management, at a very, very intimate level. A lot of owners, and this is what I said at the beginning of the podcast, they're not owners or investors. They're people who have a life and do a job. They just happen to have an investment property. So you've got to educate them, because uneducated, they don't understand about maintenance. They don't understand about depreciation often. They may have a notion about it. I think there's just a wonderful opportunity. Yeah. Wonderful opportunity. Anyway, we're going to have to round off there, guys. I thought we were going to be here all day. We love chatting, particularly catching up with you guys. We talk offline about it all the time, but it's good to get you here for a podcast.
Never waste a good crisis.
Never waste a good crisis. Phil, Alexander, I really appreciate your time. Thanks for coming in. For everyone else, I'm so grateful for you joining us. I really do appreciate having you with us. Give us your feedback, give us likes, and stay in touch, and we'll catch up with you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.